Hello everyone. My name is Slomi and I work as a Senior Program Manager at Quantitative. I would like to welcome you all for our webinar on quantitative trading using sentiment analysis. Let me welcome you to our speaker for today, who is Mr. Rajib Ranjan Borah. He is the co-founder and director of iRedge Capital and Quantitative. He designs high-frequency trading strategies for Asian exchanges, and he also regularly speaks at conferences on sentiment analysis and high-frequency trading in Asia, Europe, and America. So I request Mr. Rajiv Ranjan Borah to take it over.
Thanks a lot, Slomi, for the wonderful introduction. Hi, welcome everyone to Quantitativ's fortnightly webinar series on topics on quantitative trading and topics related to algorithmic trading. So today we are going to learn about an upcoming interesting topic known as quantitative news analytics, how to quantify news and use them for trading. So basically the session today is going to be divided into the following sections. In the first section we are going to look at, we will try to understand the methodology by which news is quantified. So basically news are pieces of text, right? So every news article is a piece of text. Now to be able to trade using that piece of text, you need to convert that into some objective numbers. You need to convert them into numbers so that a trading strategy can work on those numbers. So the first step is figuring out how news is quantified. So once you understand how news is quantified, you will be able to use the way in which it is quantified. So basically, what are the different quantitative factors into which a news article is categorized. So in the first segment, you will see the methodology using which news is quantified. In the next segment, you will then look at the profitability of trading strategies which use quantified news. Okay, so in the first segment, even before we go into the methodology, first we will look at the criticality of news and how news plays a very critical role in trading. So we will very quickly look at a few historical perspectives. So how many of you can recognize this logo? Okay, so basically this is the logo of the Rothschilds family. And then why have I put this in a webinar on news? So basically the Rothschilds family was spread all over Europe, and then at the turn of the century, that is at the turn of the 20th century, at the start of the 20th century, they were probably the biggest financial institution globally. Now how did they end up becoming the biggest financial institution globally? Well, they leveraged the power of news. So because they had a trusted network spread all over the financial institutions in Europe, they could get the financial news faster than the rest of the marketplace and then trade on the basis of the news. In fact, they had the result of the Battle of Waterloo a day before the rest of the marketplace had, and then they made a huge killing just on one piece of news. Likewise, this, the logo on the left, can you guys identify it? Okay, so it's by a firm known as Thomson Reuters. So the firm started because they realized that firms in the financial institution paid a huge premium to get news faster than everyone else. And then when they got news faster than everyone else, by trading on that news, they could make a huge killing. So Thomson Reuters started providing the services to be able to so that firms could have news faster than others. So they started employing pigeons, runner boys, Morse code, and this is how the evolution happened. Well, I gave a few historical perspectives, but then does it really work in today's context? Well, these are three examples that I had last year when I was preparing this presentation in the month of April. So there were three examples of one trader making the following amounts of money just by trading news in an automated quantitative fashion. In fact, staying close to today's date, there was one article that I read today which said that quantified Twitter sentiment analysis could actually predict that Brexit vote would happen 53% in favor of exit and 47% in favor of remain. So sentiment analysis of the Twitter feed around Brexit actually could predict the outcome of the event. Okay, so we have seen the historical perspective. We have seen how news played a very critical role in the financial world historically from the 1850s itself, and then how it's still a very critical thing today. Okay, so what is quantitative news trading? Quantitative news trading is basically the process of quantifying news articles through using computer programs. So basically these are text analytical programs which quantify news articles, provide some quantitative scores for each and every news article. So based on those quantitative scores, computer systems can then trade on them. Okay, so basically, say someone wants to trade on the basis of news. Now we all know that a news on a particular stock, a news on a particular commodity is definitely going to affect the price of that commodity. It's the first order factor that affects the price of a commodity, of the price, volume, volatility of stocks, currencies, commodities, etc. So people who trade on the basis of news are definitely going to trade on the basis of news are definitely going to do a good trade. So now either a trader can trade manually, or you can leverage the power of technology. Now, if you leverage the power of technology, what is the extent of gain that you get? So in the 200 millisecond that it takes for a human being to just read the headline, an automated text analytics program would have scanned through an entire article and figured out the sentiment of the news article. It would have broken it down into a set of quantitative factors. We are going to look at each of the quantitative factors very shortly. Now it's nice and well and good to say that computers can scan and then respond to news articles faster than human beings, and then they can process a vaster amount of news articles. But what is the biggest challenge? The biggest challenge is the fact that you need computers programs that can read through news articles and then quantify them. So that is the biggest challenge. So basically, for each and every news article that you have, you need to convert each and every news article into a set of quantitative scores. So that is the challenge. Once you convert each and every news article into a set of quantitative scores, you can trade on the basis of the same. The challenge is to convert a piece of text into quantitative scores. So let us look at what are the possible quantitative factors that a piece of text is converted into. Okay. So anyone wants to take a guess as to what is this factor that is referred to here using this hint that I have put on the slide? Okay, so basically these are different sentiments. So from any news article, the first thing that you would want to gauge and quantify is the factor known as sentiment. So you would try to figure out if the piece of text has something positive to say or something negative to say about a firm. So you would assign a positive sentiment score or a negative sentiment score. So you would say that this particular article has a negative score for Apple. This particular article has a positive sentiment score for Samsung or whatever. Now it's well and nice to know that You can quantify sentiment and then trade on the basis of the same, but then how is it quantified in the first place? Well, there are different methodologies. One of the most simplest methodologies is known as the naive parser. What it does is it just counts the number of positive keywords and the negative keywords in a piece of text. So it will say that there are 50 positive keywords which talk in glowing words about the company, and there are 20 keywords which talk not so well about the company in that article. So because there are more positive keywords in the article than negative keywords, we think it's probably good. Well, do you want to trust such a naive parser? What could be the challenges? One challenge could be you have two pieces of text. One, the first piece of text says company well A did good. The second piece of text says company A did fabulously well. Now both of them have just one positive keyword, good and fabulous. But the second keyword is much more stronger. Fabulous is much stronger a keyword than good. So therefore you would want to give different weightages to different keywords. So that is a discriminated parser way of quantifying sentiment. So basically what are we doing right now? We are trying to figure out how each and every piece of article is converted into all these quantitative factors. So we are trying to understand the different quantitative factors and how they are calculated. If we know how they are calculated, we would have the confidence to use them in our trading strategies. We would also know the possible pitfalls while using certain quantitative factors. So let's try to figure out the different quantitative factors and how they are calculated. So we talked about discriminated parser. What could be the next way? You would probably want to leverage the power of grammar, right? So you would want to break down a sentence into verbs, nouns, which noun, which adjective is linked to which noun, and so on and so forth. So uses of grammar, grammatical parsers, and then there is the machine learning way, wherein based on historical news articles, you try to find patterns, and then you say that any news article which is similar to which show a similar pattern should be assigned a similar sentiment score. Now, what are some of the issues that you should be cognizant of when you use the quantitative factor known as sentiment in news analytics? Okay, I think I'm jumping a bit, so let me just clarify the most critical slide once again. So most of you, when you want to trade quantified news, what you will need to do is you will need to have a tool which quantifies news for you. There are tools that are already existing globally which quantify news into a set of factors. So broadly, these are the set of factors that most tools quantify into. Or you would want to quantify a piece of text, a news article, to a set of quantitative factors on your own. Now, if you want to do it on your own, you would probably take inspiration from what something already exists. So, okay, coming back to where we were. So what are some of the challenges in, what are some of the ways in which the sentiment score reported by a tool could be incorrect, or what are some of the ways in which if you try to calculate it yourself, it could go wrong? Well, if you're using grammatical based parsing, grammatical based breakdown of a piece of text, these are some of the issues that could happen. Negation, double negation, sarcasm, intensification, hanging lemma. So when you say company X did terribly well, terribly is a negative keyword and well is a positive keyword. So does it mean good or does it mean bad? It actually means better, right? So but then if you just look at the number of keywords, one is a negative keyword, one is a positive keyword. Likewise, when you have hanging lemma, it says company X loses lawsuit against company Y, and then you don't know day the pronoun here, whether it refers to X or whether it refers to Y. So that is another issue. Or the same word could have multiple meanings, right? The word fine could mean a financial penalty. It could mean good. It could mean extremely small, tiny, and so on. Okay, so we had looked at the first factor. Since this is a 1.5 hour webinar with in which there will be a lot of Q&A, so I have to rush through the quantitative factors because I know most of you are interested in seeing the results of trading strategies that use quantitative news-based trading, quantitative news inputs. So let me run through the factors very quickly. So what do you think is this second factor that I've referred to using this image? You see that what the first person is saying does not seem to be relevant to the second person. They are not even interested. So likewise, there could be pieces of text which might not be saying anything relevant about a particular company. So relevance is the next quantitative factor. It could just mention that company in passing in that news article. So even though a company XYZ is referred to in a piece of news article, it might not be relevant to that company. So how do you figure out a score for relevance? So if a particular company is mentioned in a piece of news article, how do you figure out what is the relevance score for that company with respect to that news article? So this is how we could do it. Oh, this is just an example which shows how we could do it. How do you guess it is done based on this example? There are two articles, both of them refer to the merger between Walt Disney and Pixar. In the first example, it's mentioned as it's put at the very end. The header doesn't talk about Walt Disney and Pixar. It's just mentioned as an example at the very end. In the second case, Walt Disney and Pixar are in the headline. Okay. So what does this hint you? So what it means is that you could look at the number of companies mentioned in that piece of text. You could look at where it is mentioned in the first time, for the first time. Is it even mentioned in the headline or not? So if a company is not mentioned in the headline, there is a huge probability that the news article is not about that company. If it's not mentioned in the first paragraph at all, there's a huge probability that the news article is not relevant to that company. If it's only mentioned a few times and then if 20 different companies are mentioned in that news article and it is just one out of those 20 companies, it could mean that it's not that relevant. So length of the article, how many times is it mentioned, number of sentiments, total number of words in the article, and so on and so forth. Now obviously it's not an easy science. What are some of the possible issues? So I've again put a hint on the screen. What do you think are some of the possible issues in calculating relevance? Okay, let me just sort all questions by time so that I can see all questions that people are asking. Okay. Okay. So issues with calculating relevance once again. Well, the same company have had different logos. Likewise, the same company could have had different names. IBM can be referred to as International Business Machines as well. Or some people could use the term Big Blue for IBM. Likewise, Bank of America Merrill Lynch, there are 1, 2, 3, 4, 5, 6 terms that I've used to refer to Bank of America. So When you're calculating relevance, you need to know that each of those terms refer to the same entity. So you need to maintain a database of synonyms of the same firm name, same entity name. So you need to create a synonym database. Okay. The third quantifying factor. The third quantitative factor that news articles are quantified into. What do you think is this factor? Okay, so before we jump into this, there was one question that someone had asked. So in this piece of article, this is not in textual format. How could a machine decipher that for further analysis? Well, it would not be able to do that unless it is converted into pieces of text. That's obviously true. So what we are talking here is the news feeds that come to your trading terminals, the financial news provider services like Bloomberg, Reuters, Dow Jones. So they don't provide you news in with images and so on. So for the purpose of trading, each news article would be just pieces of text, and then those of you who have worked with a Reuters terminal or a Bloomberg terminal or a Dow Jones terminal would be getting news continuously as and when things happen globally, but then it's a huge amount of news that keeps flowing into your system. So if you have the news terminal open in front of you, and then if you do not filter it properly, it's just a scrolling set of series of news articles. So it's just a huge amount of news articles. To be able to trade on the basis of those huge amount of news articles that come to your terminal every point of time, you need to quantify them and let a system handle it. So this is how these are some of the methodologies that we are seeing. They quantify the methodologies are what we are studying now. Okay. So when we say that news is quantified and fed into an automated trading system, it's basically the news that comes on your Bloomberg, Reuters, or say the Dow Jones system, and then that is fed into a text analytics programs which quantifies it, and then the output of the text analytical program could be fed into your automated trading system. But then it's a good question, because you could also probably try to quantify various pieces of text on the internet, blogs on the internet and so on. So in that case, it will definitely fail. Okay, so coming back to the slide, the third factor, looking at this image, what do you think is the third factor? Well, it seems that everyone is interested in the new girl in town. So novelty always excites people. So novelty always creates interest and excitement. So novelty, newness of the news, just like a new girl creates interest in town, likewise, a new piece of news article has an ability to create much more impact in the market than the stale reporting of the same news article. Okay, so let me approach it from a different angle. So let me actually tell you some of the challenges that we have when we work on quantitative news. Say an event has happened. How is the event reported by financial news feeds? So first, the journalist will very quickly send out a very short alert summarizing the one sentence alert summarizing the event. Then he will type out a paragraph detailing the event and then send out a second message. So if you are listening to news on a Bloomberg terminal or a Reuters terminal, for every event that happens, you first get a one sentence alert, then you get an entire one paragraph article, then you get a 3-4 paragraph article, then you get updates about it, then you get corrections on the news article. So for every event that happens, you get multiple messages from one feed. Likewise, there are multiple news sources, right? You have Associated Foreign Press, you have multiple journalists reporting the same event. So for one event that has happened in the market, you could actually get a plethora of messages into your trading system, text analytical program, or quantifying news program. So you have to ensure that you do not respond on each and every news referring to the same event. You should only act the first time you read about the event. You shouldn't respond every time the event is referred to in a news article. Moreover, news also causes price changes, which themselves become news, by the way. So you have to be also careful about that. So if you do not keep track and respond to repeated instances of the same news, we will end up repeating our actions manifold for the same event. So we should check for newness before responding. Likewise, how is the novelty of a news article quantified? Well, what you do is you create a map of the keywords in a news article, you compare it with a historical news article for the same firm, and then if you say that, hey, I saw a keyword saying accident, and then this is again another keyword saying an accident, so probably both of them refer to the same event. So the first one talk about a fire at a plant, the fire, and the second one also has the keywords fire plant. So probably both of them refer to the same event. So let me not respond to the second event. So yeah, you keep a count of the linked articles and similarness and so on and so forth. So that is how novelty is calculated. It's one of the more difficult factors to quantify, unlike sentiment, relevance, and so on. Okay, the fourth factor, what does this look like? Okay, so what it means is the ability to impact. What is the likely impact of the news article? So what you do is you categorize various news articles into different news types. You say that a news article of a particular type has a much greater ability, likelihood of affecting prices in the market. And then you say that a news article of another type has a different likelihood of affecting the prices. So you create a set of categories. Now, what are the type of categories that you could create? One is the type of news, whether it's an financial news, which is accounting news, so basically all this guidance, financial issues, blah, 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 or whether it's a strategic news. You could create a whole host of types actually. So these are just two examples that I've given. So one way of categorizing is whether it's an accounting or strategic news. There are other types as well. So that's a very detailed topic in itself. So you know that if it's something about guidance, historically, what is the impact that such news articles had, versus if it's something about M&A, what is the likelihood of effect on the prices and so on and so forth. So you could also do categorize on the basis of expected, unexpected, and so on and so forth. While the four factors that we have discussed till now, while the four factors that we saw how they were computed, and we saw how they could be computed incorrectly as well. So these are the most critical ones. But in addition to these four factors, there are a few other factors as well. So what is this fifth factor? the volume of news on about a particular event. Just the past weekend, everyone was talking about the referendum that happened in UK. And so it meant that the news event was probably a very significant event. And wasn't it significant? The markets were so very violent. So basically the amount of news on a particular topic would say that what is the likelihood of impact of the news on the market. So you could track the number of news on that event. You could also track the number of people actually interested in a particular, likewise, you could also track the number of people interested in a particular product, particular firm, particular company, and so on, right? So at the start of summer, if more people are Googling for, are searching the internet for holiday destination in Greece versus searching the internet for holiday destinations in Croatia, you could say that probably the tourism industry in Greece will do better than the tourism industry in Croatia, right? And then the good thing is Google actually provides you search trends on their website. You could actually, there is a tool within Google which is available to everyone. You could actually look at the number of search queries on each and every topic. So you could say that if more people are searching the internet for a particular brand versus another brand A versus brand B, it could possibly mean that there is more interest in brand A. For example, in this snapshot, you could see that more people were searching, interested in knowing about Facebook, searching the internet for Facebook in mid 2007 onwards, than another competing social network called Orkut. And likewise, you could see the number of queries for MySpace was also decreasing in around the same time. So what does it mean? At that point of time, if you could invest, if none of these companies, means if you could invest in any of these companies, you should have invested in Facebook rather than MySpace or Orkut at that point of time. Okay. Now, since we talked about social media, how else can you leverage social media? You could actually look at, since we used an example for social media, it actually brings us to an interesting point. You could also look at the buzz in social media for a particular product, for a particular company, and so on. So immediately after a release of a new Apple iPhone, if you see more people on Twitter talking about it positively, or if you see that the number of people talking about it positively is much lesser than what you expected, or if you see people are talking about it negatively, you could take a trading decision on the basis of the same straight away, right? So you could quantify, and then there are various open source tools available which actually quantify Twitter feeds, the volume of the huge volume of Twitter posts. There are APIs that you can use to quantify Twitter feeds. Not just that, there are certain news analytical tools. The vendors, they provide you market psychology indices as well. So what it does is, it's not possible for me or you to keep a track of all the news articles in a particular country, or forget about all the news articles in a particular country, even all the news articles about a particular industry in a particular country. So it's not possible for us to manually do it, right? But you could use an automated quantitative system or a computer program to scan through all the news articles about a particular industry of a particular country and generate some broad sentiment scores. It could say how much is customer anger depicted in news articles about a particular company? How much is optimism referred to? How much is optimism seen in the news articles about a particular company? How much do news articles about a particular company talk about innovation? So you could create broad indices on the basis of a huge number of news articles. So you form macro views on the basis of just broad indices which are calculated on the basis of huge number of news articles about the same country. So you could say how much is conflict mentioned in news articles about a particular company, how much is joy or fear referred to. So since we are on this topic of market psychology index, and then it might not seem very straightforward and interesting straight away. Let me actually show you some of the profitability graphs. These are things that most of you enjoy, right? So I see that I have gotten quite a few queries now. So, but then let me take that at the end of this first segment. So I'll take all the queries together. Then we'll move to the second segment, which is the one that most of you are interested in, the profitability part of it. Okay, so what does this graph show? Well, for the technology sector, innovation is very critical, isn't it? So if you don't innovate, you could become extinct. You look at the example of Nokia, you look at the example of BlackBerry, you look at the example of Kodak. So various technology leaders, they became extinct because they were not innovating. So innovation is very critical in the technology sector. Now, which is the benchmark for index for how technology firms are doing? Is the NASDAQ index, right? Because most of the biggest technology firms are in the US, and then at least currently, and NASDAQ is the default exchange for all technology stocks. So if you track the NASDAQ index, and then if you track the market psychology index called innovation, so you look at it, the index broad macro index called as innovation. So how much is innovation referred to in news articles versus how did stock prices of technology stocks move at a broad level? What we see here is that people started talking about innovation much before than changes in stock prices of technology stocks. So news articles about started talking of innovation much before the stock prices of technology stocks started going up. So if you use that as a feed, you could have traded better. But here it's not that sharp a relationship as here. If you look at news articles and see how earnings expectations are referred to in the news articles, do they talk about better expectations of earnings or poorer expectations of earnings? It actually preceded the actual price changes of the broader equity index, the S&P 500 in the US, which is the best gauge of how the equity segment is doing in the US for the top 500 companies in the US. You could see that the broad sentiment index about earnings expectations actually preceded the market by quite a few quarters, actually 3 quarters. So you could have traded 3 quarters prior to the event happening, and then you would have traded better. So we had looked at the 4 prime factors, ways in which news is quantified. So what are those 4 factors? You convert a piece of news article and come up with sentiment scores about the news article. Number 2, you also convert a piece of text into the, you also calculate the relevance of the news article to the company mentioned in the news article. The second is relevance. The third one is novelty. Is the news article talking about a old new event, or is the article talking about a very fresh new event? Okay, so the third one is novelty. The fourth one is the type of news and therefore the market impact possibility. So the type of news is the fourth one. Then you also could look at volume, search trends, and social media trends. Okay. So it was nice to know that the way in which news is quantified. It's interesting. It's from an academic perspective, from an academic standpoint, it's nice to know how news is quantified. That's well and good. But then, how is it? Does it make good trading strategies? Well, the theory is nice to know, but in reality, how beneficial is it? We need to see the money, right? And not just an image of money like this, but then we need to see money in our trading screens. So in the second segment, we are going to look at the profitability of trading strategies that use quantified news as inputs in the strategies. So does it really make money? The most important question. Okay, so before we get into the second segment, let me take some of the questions that have come up on my screen. So there was a question, how do you calculate the targets and stop loss for the particular trade? So which trade are you referring to? Okay. I'll leave it at that. Okay, so are there good news APIs for economic calendars, say crude oil inventory release? I'm looking for data like actual, estimated previous values, preferred in separate fields, which my trading application could read and act upon. Well, there is a very interesting question by Mr. Vivek Gadodia. Are there news APIs for economic calendars, say crude? Okay, so in fact, there does exist. Let me explain it to you how it is done. So let me draw that on a piece of board, on my board. So various data providing services like Bloomberg, Reuters, what they do is for fixed events, they actually provide details about the event in a standardized structured message type rather than providing it in the piece of text. So they wouldn't say that the US Fed made a decision about interest rates, they increased the interest rates by 0.25%. They won't give a piece of text like that. What they do is they would say that this piece of text is about US Fed rate. So this would have a particular code. Then here they would say this was the previous interest rate, new interest rate, or and the reverse repo rates or whatever. Or it could, likewise, it could have been, the code could have been crude inventories. The next field would have actual and blah, blah, blah. So it would have the information in a fixed location in a fixed message, in a message type which is designated to provide this information. So it actually does provide it exactly in this format. So in fact, I have a picture of it later in the presentation. Okay, so Mr. Gopinath Ramkumar has a question. What if there is a lack of symmetry for the same news? How will we validate? Hi Gopinath. So in fact, he has a follow-on question on the same thing. Say if there is equal positive and negative keywords matching for a news, then will you categorize them as neutral? What other factors to look for? Okay, this is a very nice question actually. So Gopinath was a student of our EPAT program a few years ago. So hi Gopinath, so this is, here you see sentiment. Instead of one field, there are 4 fields. What you could do is you could have a classification of whether it's a positive sentiment or a negative sentiment. What you could also do is you could say that what is the positive sentiment in the news article, what is the negative sentiment, neutral sentiment, what is the negative sentiment. So how many keywords talk about positive, how many keywords talk about negative. If it's extremely one directional, then you would want to trade on that. But if it's not extremely one directional, you would not probably would not want to trade on them, right? So for this news article, 42% chance that it has positive sentiment, 30% chance that it has negative sentiment. So you would probably not want to trade on this, right? So you could have one quantitative factor, or nothing stops you from having multiple quantitative factors for which are similar, which are linked to the same broader factor, right? Didn't say any example in Indian market, and that too a latest example, but there are quite a few, so what I'm doing in this presentation, I'm showcasing studies done on quantified news for trading, which are available in the public domain. So most of them are from the global markets because the number of firms, the number of news sources are way higher. So or just that the people doing the research are from those countries and then understood those firms better. So understood those geographies better. So most of the studies unfortunately aren't from India. So the ones that I will be discussing here. Okay, now there is one more question. What if the brand new news has been created and published just to create chaos in public? Okay, so that's a very interesting question. So what if someone creates fake news just to cause chaos in the market? Now, when you are using a Reuters, Bloomberg, or a Dow Jones news terminal, so you get news from this sources, right? So within there, what you can do is one, they do their own sort of filtering. So they just don't let any random journalist publish any news article and post it on their news feed. Two, even so basically within these news feeds, what they would do is they would have their own journalists, plus they would also publish news from other journalists, but then they would only publish for journalists that they have already verified. Now you could run quantitative news analytics on only news articles published by a Bloomberg journalist or by Thomson Reuters journalist or a Dow Jones journalist. So you could do that, number one. Or you could say that, okay, I only want to do for news sources which are verified to be from good sources. Or the third option is you could say I can do for, I'm open to any news source. So you could do that as well. Or you could say that, yeah, so you could do any of them. But then most of these news sources anyway filter out the source of news and so on. But it's a very interesting question that you have asked. What if there is a fake news? So in fact, we are going to see some examples of fake news. So how the world went topsy-turvy when someone hacked critical news accounts. Okay, one more question. Also, timing of the news is important, right? How do we calculate the time between the news for the same event? How do we calculate the time between the news for the same event? Well, it's true. So if a very old news article is published again, so if an event happened in 2008 and the article talked about that event but then didn't mention the year or so on, automated analytical tools could get fooled, and then that is where these news the tools available in the market, they have spent so many years researching to ensure that when they provide you a novelty score, it is truer to what it really is, and so on. There is one more question. Are there checks to avoid sudden fluctuations? So, sudden fluctuations. Fluctuations in what? So basically, the quantitative news, you get news. Okay, so let me explain it using a diagram. You have news from various sources that comes to your text analytics program. The text analytics program gives you a set of quantitative scores for every piece of text, every piece of news article. The same is fed into your automated trading system. The automated trading system has its own complex event processing block. It has its own order manager. It has its own risk management system. And it would possibly also get market data from the exchanges. And it would send out orders to the exchanges. So whenever a news event happens, the text analytical program converts them into a set of quantitative scores. It goes into an automated trading system. The automated trading system could also be listening to market data. Now, how do you handle sudden fluctuations? So fluctuations happening in the market data is a different thing altogether. This is here. Your news is here. So there could be fluctuations in the market data elsewhere. This actually goes to your complex event processing block. Market data is denormalized and sent to the complex event processing block. So the way you handle fluctuations in the market data is different. You could have an automated trading system which says that, okay, even though the news sentiment is extremely positive about this company, but then I see a lot of fluctuations in the price, so let me stay out of the market. Or you could say that I see a lot of fluctuations. Probably there is uncertainty, but then I've just got a news article which says the event has turned out to be very good for the firm. So while there is uncertainty, but then I know from my news feed that it has turned out to be very good, let me send out an order. So you can do that here too. Okay, next question. During earnings season, there are times when companies come up with very good results, but then the stock price of the company falls because the news is already discounted. If you based on quantified news, we may incur loss in that case because it will suggest buying the stock. Okay, this is a very interesting question again. So remember I talked about structured news. So basically this is structured news. What is structured news? The news is provided in a fixed structure. So a lot of these news vendors, they also provide company earnings in a structured news format. So what they do is they would say that this is a earnings release or earnings guidance type of message. Then they would say the name of the company name, basically company ID, instrument firm ID. Then they would say what is the revenue, profit, cost, taxes, provisions, appreciation, depreciation, and all sorts of things. So when you get earnings release in a structured news format, you would say that, okay, they have done well, so their expected, say their expected profits was 100 and their current profit turned out to be 120. But you know that you could say that 100 is already priced in the market, or you could say that 130 was already priced in the market. So the way you treat a piece of news versus the way the others treat the same piece of news is different, right? That is where your differentiation comes into the picture. So you could say that, okay, if the earnings release turns out to be just slightly positive, I think people have already factored that in. So your automated trading systems would get the news about the earnings release in a structured format into their system, and they could trade on it straight away. And when they trade on it straight away, they could use each of those pieces of information in a different way. So the way I look at revenue, where I look at profits versus someone else looks at profits or costs. So each of them is a quantitative input, right? So I could say that anything below 110, it's time to sell, while someone else could say anything above 105 for profits, time to buy. So it depends. So that is what happens in the market. So people have different expectations, and then they form their positive or negative bias accordingly. So the news vendors have made it easy for you to automatically analyze it. So instead of providing an earnings release as a piece of text, as paragraphs after paragraphs of text, what they do is they provide you in data in a very structured format. So you can actually feed them as inputs into your trading systems, and then have trading rules and then trade on it automatically. Okay, so one more question that I have here is, since news comes as alerts and then as detailed articles, then as updates, at what stage do you decide to make a trade basis on the basis of news? Okay, so that's a very interesting question. So basically, as we will see just slightly in a few minutes, the way you trade news, you could either try to be the fastest person to react to an event. If you try to be the fastest person to react to an event, in that case, you would most likely want to respond to an alert and not wait till the entire thing has gone out. But if you're trying to trade by forming a broad index, by forming a broad macro viewpoint, you say that, okay, out of the 1,000 news articles that have been about Coca-Cola in the press, 700 talked very well about Coca-Cola, 200 were neutral, and 100 were talked about it in not very good terms. Then you can say that it probably means something good about Coca-Cola, right? So what you could do is you could try to form broad sentiment scores and then trade on the basis of the same. If you are trying to trade on the basis of broad sentiments, you would not want to trade on alerts. You would probably want to trade when you have the full message. Okay, there is one more question. But this Reuters, Bloombergs are paid ones, right? Do they provide free API? No. The process of converting a piece of text into quantitative scores is a hugely complex task. So these firms have invested huge amount of money in technology, but more importantly in human resources to be able to do that. They have spent more than 6-7 years just doing the same thing and refining it so that the scores that they provide are more closer to reality. So these are not free tools right now. Okay, there is one more question. Okay, so there is a very similar question. Can you set your strategy based on earnings? Example, earning below 1, sell, earning below 1.25, no action, between 2.27 and 1.75, the weak buy, earning above 1.75, strong buy. Yes, you could do it because you get structured news. So you don't have to go through, scan the news article line by line and then try to figure out what is the earning. The earning is actually provided to you in a fixed location in a different type of message packet itself. Okay, Mr. Kishore Kumar, is it good to automate sentiment analysis with trading strategies without human filtering? Well, it again depends. There are two ways in which you can use quantified news in your trading strategies. The first one is you could try to be the fastest. If you are trying to be the fastest, but you want a human filtering, you might not be as fast as someone who is doing it automatically directly. For example, when the news earnings release comes out, people who have already fed it into the system saying that in above 1.75 buy, between 1.75 to 1.25 no action, less than 1.25 sell. So they are going to be way faster than a human intervention. But on the other hand, if you're trying to trade on the basis of a broad macro viewpoint that you're trying to form by letting your system scan through thousands, tens of thousands of news articles, in that case, you are not looking to trade immediately. You are looking to trade based on a viewpoint that you can form of the news articles that have come up in the last weekend, last fortnight. So in that case, the system would say that, okay, at a broad level, I think technology stocks, the amount of innovation that they are referring to in technology stocks has come down. So sell technology stocks. I think the news articles have started saying very positively about telecom stocks. So buy telecom, sell technology. So there could be a signal of that sort based on news analytics. Now, before taking the trade, you could obviously try to understand it from a fundamental from first principles. There is nothing that stops you from filtering. Okay, the questions are just keep coming. I hope I'm not getting behind schedule. There are stocks which are cyclical in nature, but there are changes and updations happening in company between one cycle past and next is yet to come. So how exactly so differentiate what is important, what is garbage? Well, your question itself has the answer. You said that there are cycles in the company, and then certain pieces of news could mean differently in different cycles. Well, if you are listening to all the news about a particular company and quantifying each and every news, the moment the cycle changes, you would be able to from a fundamental perspective, the cycle, something has changed about the company, that would show up as one of the news, and then you would see it in your screener, right? So from a fundamental perspective, if you're already listening to all of them, you would be able to see that directly. Okay. 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 So let me again move back to the rest of my presentation, because I know that most of you would be very interested in seeing the money. Okay, so the first example, how many of you are cognizant of the deep water horizon oil spill by British Petroleum? So they were fined hugely, right? $15 billion, $20 billion, I don't remember. So it was in the Gulf of Mexico. One of their oil extraction processes had a failure, and then they had a huge spillage in the Gulf of Mexico, so which affected the ecosystem very badly. 10 or 15 or probably $20 billion fine. So when you have such an event, the moment the news comes out, obviously the stock price is going to tank. Okay. The next thing is, what is of interest? These are the prices, this is trading volumes, this is the news sentiment. Now, if you look at it, the news sentiment, obviously turned negative. But then here you can see that the news sentiment had a change in direction. So it started becoming better and better at this point of time. But when did the stock prices go up, stop falling? It continued for some more time. So if after the sentiment started becoming positive, you said that, okay, there is a turnaround, so let me now see if the stock prices have turned around. No, the stock prices have not turned around. So at this point, the sentiment started turning around. So if you say that, okay, once a turnaround has happened and then the sentiment has gone up by this amount, I'll take a trading decision. So you would have actually ended up buying the stock at this price, which is almost close to the bottom, right? So that is one example. Okay, there is one question. I'll just quickly take this. If a news is available to everyone on channels like Bloomberg, then how? Okay, so it's not available to everyone on Bloomberg, by the way. So while news is available to everyone on Bloomberg, the ability to quantify each and every piece of news, you could try to build your own text analytical software. So we already saw how the existing vendors calculate scores like sentiment, relevance, novelty, etc., etc. So you could try to calculate on your own, or the leading vendors, Ravenpack in conjunction, in partnership with Dow Jones, Thomson Reuters, or Bloomberg, they also quantify each and every piece of news and then provide you a score for each and every piece of news. But then if you take a normal terminal, you do not get the quantified scores. So you would need to subscribe to an additional quantified news service for with Dow Jones or with Thomson Reuters or with Bloomberg to be able to get the quantified scores. Okay, so we had already discussed this. There are two ways in which you can use quantified news feed. One, because machines are faster at responding to events than human beings, therefore you could try to be the fastest to respond to a news event. Okay. The second thing is, because human beings cannot read a huge plethora of news articles and then try to figure out meaning and then stay sane after reading so many news articles. So you could actually use it to analyze a broad viewpoint across all news articles. More than that, so if there are 100 news articles about in a particular economy of interest, a single person cannot read all those 100 articles in one day, probably say. You assign it to two different human beings. Both of them, the way in which they interpret the news article would be different. Now, the scores that one person will be assigning will be grossly different from the scores another person will be assigning. To stay objective, and to stay impartial, what you can do is you could let the computer score the news articles and then assign sentiment or novelty or relevance scores. When the computer assigns the scores, even after doing it for 10,000 or 20,000 articles, it will still use the same methodology and still keep doing the same way. So it's an impartial standard way. Okay, so very quickly, there's someone who has a few questions about our course. So I'll take all questions about our educational program at the end of this presentation, because this presentation is mostly about news analytics, and at the end of the presentation I'll explain everything about our course, the way it's structured, what do we cover in our course, and so on and so forth. And in addition, our sales executives who are also listening on this call, they can get in touch with you separately, and then they can explain to you about the course separately. Okay, so coming back to the presentation, we had already seen, so amongst the two types, analyzing broad spectrum of news to formulate viewpoint, we are already seen how forming broad viewpoints was beneficial for trading technology stocks, for making viewpoints about earnings expectations. Now the second methodology, low latency based trading. What is the challenge to trading low latency? In trying to be the fastest to respond to a news event? Well, the challenge is that you need to have confidence in the quantification of a news article. So if a text analytical program says that a news article is possibly good about a company, and then it actually turns out to be bad, you would have bought when you should have sold. There is a news article, it says something very good, then your quantifying algorithm says that it has a negative sentiment, you are obviously going to do a bad trade. So the biggest concern is, what is the accuracy? If you have confidence in accuracy, you will be able to trade low latency. You would be able to try to be the fastest to respond to an event. Okay. For events like company figures, economic calendar releases, these are actually provided in a fixed structure. As I mentioned, so this field would give the revised, this field would give the actual, this field would give the estimate, and so on and so forth. So for expected events, standard events, you have structured news which is provided in a structured format. So if you respond to it, you are likely to be good. But for unexpected news, news which has pieces of text, how strong, how reliable and trustworthy are the quantitative scores. So let us look at some of the examples. This is a very famous study done by Tetlog, Saar, Sheshansky and McCarthy. So what they did was they categorized all news articles and spread them out. They said that let us look at news articles which had positive sentiments, news articles with negative sentiments, moderately positive, slightly positive, strongly negative, and so on. And then they formed this distribution of price changes with time, and then the sentiment of the news. So what it shows is that at the end of the day on which the news event was published, even if you take a trading decision, even if you trade at the end of the day, not even at the time when the event happened. So if you trade at the point of event, you are likely to do a better trade. But even if you trade at the end of the day and buy a stock with a positive sentiment and sell a stock with a negative sentiment, you are still going to buy into something on which the price is going to go up, sell something on which the price is going to go down. So even if you trade at the end of the day, you are still likely to do a good trade. So if you trade at the point of the event, you are likely to do even better. Not just Tetlog, even Thomson Reuters did the same study. Number of days since the event. So on the day of the event, if you entered a trade at the end of the day, so this is when the event happened probably. So the stock price went up. This is probably when the event happened. Negative news, stock price went up. Positive news, stock price went up. So even if you trade at the end of the day, and if you consider this as the 0 point, if you consider this as the 0 point, so if you trade at the end of the day, you are still likely to make money by buying stocks with positive sentiment, selling stocks with negative sentiments. So this actually gives you confidence that the sentiment scores generated can be trusted upon, because if you look at the sentiment scores, it gave a positive sentiment, and yes, the stock price actually went up. It did not just went up during the day, it even went up after that day. So even if you had entered into the trade at the end of the day, you could still make money. In fact, how much money? You make 55 basis points if you take the 90th percentile of news articles within the top 90th percentile of sentiment scores, where novelty is totally, so it's a totally new event. So you make 55 basis points of returns. In fact, when you look at the 95th percentile of scores, the returns went up to 138 basis points when you buy the stocks with positive sentiments and sell the stocks with negative sentiments. And mind you, we are talking about entering the trade at the end of the day, not even at the moment the event happened. So if you entered in, if you tried to be the fastest to enter into a trade and did the trade here, the moment the event happened, you would have done even better than 138. Or in fact, for certain sectors like financials, which are hugely affected by news, you could have even gotten 147 basis points if you just entered at the end of the day. This is from a study by Thomson Reuters. Okay, so I said if we move from non-cyclicals to financials, the profit increases. What does it mean? It means that possibly certain sectors are much more sensitive to news than other sectors. Wouldn't you agree? So this is what another study said. So they looked at the correlation of news and activity. Pharmaceuticals is most sensitive to news. In fact, from my own trading experience, I can tell you, trading statistical arbitrage strategies on the pharma sector is usually risky, because the moment you have any news on any of the companies, all historical statistics go for a toss. Well, it's because of the fact that in the pharma sector, firms spend so much in R&D, and then they make an application with the regulators, and then after a few years with the regulators, suddenly the regulator will say that, okay, your new drug is approved, or they will say that your new drug is not approved. And then it's a hugely expensive gambles. These are hugely expensive gambles. Like they invest a lot in R&D, then they go to the regulators. It could either be approved or it could be rejected. So these are about firms which innovate, and then likewise you have firms which just create the generics. So you could have the FDA regulators, the health and environmental safety regulators. They could come visiting your plant, and then you could have, so pharma as a sector is the most sensitive to news. Financials are also hugely sensitive to news. So basically this graph shows you which sector is how much affected by news. So not just sectors, likewise the size of the firm also has an impact, has a relevance. Now the number of financial analysts analyzing a big firm is way higher than the number of financial analysts analyzing a small firm. So if an event is happening in a small firm, it's possible that no financial analyst is even tracking it. But if something is happening, say at Apple or Facebook, you have so many journalists just prying their eyes on what Facebook is doing, what Apple is doing, what Samsung is doing, what Microsoft is doing. So if something happens there, it's likely that people would have picked up signals much earlier. People would have noticed some other, noticed it noticed it much before it blew up into a big event. But in case of small companies, because very few people are watching it, very few people are noticing it, very few people are monitoring it, so it's possible that things could blow out before people have noticed it. So if things blow out before people notice it, so therefore the likelihood of impact of a news article is way higher for small firms. So if you are a small firm, the likelihood of a positive upswing or a negative downswing on news, positive or negative news, are way higher than the amount of change in prices when on a big firm. How else can you make better trading strategies? So if you use, if you say that, okay, I'm going to buy stocks on which the news articles have a positive quantitative score. And likewise, if I sell news stocks in companies which have negative quantitative scores. Now, if I do that, if I just trade randomly, these are my returns. If I buy stocks with positive sentiments, these are the returns. So this is the number of companies that I've traded. So the more companies I trade, the returns come down. The less the number of companies that I track, the better the returns. So what you could possibly do is, instead of buying multiple stocks with positive sentiments and multiple stocks with negative sentiments, you could only focus your attention on the ones with the highest sentiment scores and the highest relevance. Moreover, it's better to do both buy and sell, because you don't want to be exposed to the economy, right? So in 2005, in 2006, and 2007, if you bought stocks with the only with positive sentiments, best positive sentiments, you would have done well. But if you did the same in 2009, if you bought stocks with the best positive sentiments, if you did that in 2009, you would have actually lost money. 2008, because 2008, everyone knows what happened. Lehman crash, Merrill Lynch had to be merged with Bank of America, Bear Stearns crashed, so had to be bought by JP Morgan. AIG had a similar story. So you are exposed to market regimes if you only buy or if you only sell. So if you only sell, you would have lost money in 2005, 6, 7, but then you would have made money in 2008. Do you want to do that? No. So you want to stay market neutral. So if you stay market neutral, this is how you would do. You would make money in more than 1.5% monthly returns. You would make more than 1.5% by selling stocks with negative sentiments. So you make money on both sides. So being long positive sentiments and short negative sentiments at the same time gives consistent returns. Okay. What else? The regime that you are in volatile markets, people tend to react less strongly to positive news and react more strongly to negative news. In volatile markets, when people are scared, when there is panic all around, when you get a negative news, there is a much stronger response than the responses to positive news. Okay, so these are the historical observations. So this is what has been observed historically. What else has been observed historically? So in stocks with low beta, so what are low beta stocks? These are stocks on which not much movement is expected, not much change in prices are expected. So stocks with beta is basically how much does the stock price change when the broader market prices change. So broader market index changes. So a stock with low beta means the stock price doesn't change much when the index broader market changes. So these are basically sleepy stocks. Now in sleepy stocks, when you suddenly have a news, then it's a surprise to everyone, and then therefore the price changes is much higher. So when you are using quantified news, when you are quantifying news and then feeding them to your automated trading systems, remember that if you get a signal on a stock with a low beta, because people do not generally expect much from those stocks anyway, when you have a news, it could have a big impact. Likewise, when the volatility regime is calm during those points of time, surprises during calm times cause huge movements. Likewise, when markets are improving, that is surprise to mostly long position holders. So 2010 was an improving period, 2011 was improving. So when you had news, those had much greater impact. So in fact, low market returns, higher market returns. During period when the market returns were high, whenever a news came up, the impact on prices was much higher than when there was much lesser news. Okay, a few more strategies and their profitability analysis. So this was done by a person called Marcelo Dion at JP Morgan, London. Okay. So what did he say? What did he find out? So he said that, okay, instead of looking at absolute sentiment scores, let me look at score change in sentiment. So I'll buy stocks where the sentiment has gone from extremely positive to negative, or has gone from has jumped up a lot recently, or has reduced a lot recently. So instead of saying that, okay, this company has an overall sentiment score of 75, I'm not going to look at that. But if some company had a sentiment score of -5 and then that became 65, that means a lot. And that means very good about that firm versus a stock which was already at 85 and then its positive sentiment score went from +85 to +75 versus another company where the sentiment score went from -5 to +65. So -5 to +65 is better than +85 to +75. So instead of looking at the absolute score, let me look at how the sentiment score has changed. So if you buy stocks with highest increment in sentiment and sell stocks with highest decrease in sentiment, well, it actually didn't do very well till 2005. So you need to figure out how was the market behaving till 2005. But 2005 to 2010, it did very well, even though it lost around, went up 40% and lost 40%, 60% as well. But then if you stayed invested in this strategy, it did well for you. It doubled your money from 2005 to 2010, 5 years. Another strategy, what you could do is change in sentiments for sure, but then only buy stocks where a reversal in sentiment happened. So a stock in which the sentiment was grossly negative, if it suddenly became positive. So whenever there was a change in sentiment from grossly negative, if it suddenly became positive, so it means that something which was not doing well has suddenly, there's something good suddenly happening in that stock. So it's just buy it. So bottom fishing. So if you buy such stocks, you get good consistent returns actually. 300% in 7 years, and then more than that, you don't have much drawdowns. So this is actually very interesting. Okay. Now remember we talked about news type of news, category of news. So soft news, which is opinion based news, have a much lesser impact on prices than hard news. What is hard news? Fact based news. So these are hard news. Hard news, if you have a hard negative news, the prices are going to drop much more than just a negative opinion. That's expected, right? So, okay, let me not spend much time on which is self-explanatory. Okay, the next thing, scheduled expected versus unscheduled. Expected versus unexpected. So as I mentioned, when a news article comes as a surprise, the impact is actually much more than when the news article doesn't come as a surprise. So you take two news articles. Both of them had similar sentiment scores, similar relevance scores, and obviously similar novelty scores. If the news type of the first is scheduled, which is expected, and the news type of the other is unscheduled, which is unexpected, the market impact of the unscheduled news is actually often higher than the market impact of the scheduled news. More so for positive news. In case of negative news, even if it's unscheduled news, even the market drops almost equivalently. And likewise, there are other types of news, so you can look at hot news flash, blah, blah, blah. So you can say that in case of positive news, whenever the flash comes up, people buying straight away at the moment of alert, a flash, hot news flash gives better result. But in case of negative, people would prefer to actually get a detailed post the detailed article, the market drops the most. So while the amount of up move and the down move at the news flash is probably the same, but the amount of the down move after the full release is even worse. Okay. So just to summarize, we had seen various scenarios. Each slide had one scenario saying that when is it good to use news analytics, in what scenarios does it work well, what scenarios does it not work well. So just to summarize, in case of small cap stocks, news analytics works well because fewer people are tracking it. So when a news comes up, the impact is much more. So if you are using quantified news to automatically trade on that news, you will be reacting to something which very few people are tracking. Okay, next. Sectors, some sectors are hugely sensitive to news. Third, stocks which are generally sleepy stocks, which generally don't move much. When you suddenly have a news on them, they move a lot. So stocks with low beta. What else? When the market regime itself is stable, and in that stable market regime, you suddenly have a news event. So when the VIX is low and you suddenly have a news event, so in that case, the impact of the news could be high. When markets are improving, hard news versus soft news, unscheduled news events versus scheduled news events. So on unscheduled, unexpected news, the impact is much more than in expected news. It's better to be in both bought and short, doing fewer stocks, but those with stronger signals give you better results. Okay, so all these talk very positively about quantified news and how it could be used for how news is quantified, how news, the quantification of news is actually very nicely has progressed so much that the scores can be relied upon, can be trusted upon, are very strong. But in addition, in a variety of scenarios when it does well, okay. But where does it fail? Well, you need to train your system, and the system works the way it is trained. Now, if you train it to say that okay, Osama bin Laden is not a good good thing for the equity markets. If you train it and tell it that the word killed is not a positive sentiment for the markets. Now, the moment you have a news article with both these keywords, the market is going with both the keywords. The market, the system might say that the news article doesn't mean something good. But on May 2, 2012, when it was reported that Osama bin Laden was killed, there's a news automated text analytical software saw two negative keywords and thought that it was a massively negative news article, and then automated trading systems which use these text analytical programs lost money. Okay, now there was also this question asked by someone early on saying that what if people are referring to an old event in a news article? How well does it protect itself? Well, it actually happened that in 2008, Google picked up an old 2002 article about United Airlines. What happened in 2002, by the way, because we are talking about United Airlines in 2002, it's very interesting. So I'll just put the question. So the 9/11 attacks caused a lot of panic globally. So people were scared of flying. Two airlines were actually used to break the Twin Towers. So flying by air became very difficult. You had all those new security checks that were put in place. So airlines industry had a huge downturn at that point of time. So United Airlines also faced those problems, and in 2002 they talked of possibly filing for bankruptcy. And then in 2008, when Google suddenly picked up an old news article by mistake and published it, and automated news analytics softwares analyzed that news article and assigned negative key sentiment scores to United Airlines, automated trading systems started selling United Airlines. So the stock price dropped, and then suddenly people realized that, hey, this article is not relevant. It is not novel. It is talking about something very old. Okay, so there was another very interesting problem that someone mentioned. So you guys are actually very smart. So you have picked up some loopholes in the potential loopholes in utilization of automated quantified news in trading. So what was this loophole? So what if there is false news? Now, to protect against false news, most of these vendors, what they do is they say that, okay, we are only going to accept news from trusted sources. We are not going to accept news from untrusted sources. Now, what if the trusted source itself is hacked? What you have if someone has hacked the account of the trusted source itself and sends out a fake news article? So this is what happened. The Twitter account of Associated Foreign Press was hacked. They put up a tweet saying the White House has been bombed. Automated trading systems read that tweet, acted on it. They sold the markets. The markets realized it's a fake tweet. It recovered immediately, but then the markets did drop 0.8% straight away. What are other challenges? Well, in geographies like China and Japan, the number of alphabets, the symbols in the language are huge. How do you quantify something when the language itself is so complex? The amount of news articles, the volume has also gone up drastically recently. So that is also what makes life very difficult, right? When you have so much to process, how do you know what is reliable, what is not reliable? You could have people hacking into your system. So how do you trust? So that is another problem. Okay. Okay, so now that we are done with the second segment, I don't see a lot of questions from the second segment, but let me take all the let me go through all of them. So any reply, I could not follow it correctly as I had. It's someone from Latin America. So Lionel, I hope it's not Lionel Messi. So I hope it was Lionel Messi. So this webinar will be recorded and then it will be put up on YouTube, I guess. So at any point of time, if you want to refer to what was being discussed in today's session or look at the slides in today's session, you could definitely go back to today's webinar. Okay. Oh, now I see a lot of questions that have suddenly come pouring in. Do you see news-based strategy with machine learning, deep learning? Well, machine learning is actually very critical because you have just so much information. Let's look at this. Every piece of text is converted. Oh, we actually did cover quite a bit of material in the past 1.5 hours. So every piece of text is converted into so many quantitative factors. When you convert one piece of text into so many quantitative factors, now how does this factor impact prices? 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 You don't know. So machine learning is the way to go actually. So what is machine learning? So instead of saying that, okay, I know which factor affects the output, you just provide the output and you provide all the hundreds of inputs. Now machine learning, it will tell you which out of these 100 factors impacts the output. It will tell you that, okay, while you have provided me factor number 1, 2, 3, 4, 5, 6, 7 up till 100, only factor number 35, 71, 49 and 68 is relevant to the output in determining the output. So that is one way. So machine learning is definitely very critical. In actually designing strategies out of quantitative news. Which algorithms, machine learning and others, are popular in news analytics? Is there any research literature available around it? Well, there is quite some research material available on this topic. You can contact me through the sales guys, sales executives after the event, and then I can share some of those research materials. Oh wow, there is someone who says hi from Colombia. That's interesting. One more question: can a retail investor without significant investment use sentiment of the question analysis to trade equities? Well, the challenge for retail investors is if you want to get a tool which quantifies news into quantitative scores for you, the available tools are expensive. The most popular ones, Thomson Reuters, Dow Jones Ravenpack, and Bloomberg. So the three big tools, Thomson Reuters, Ravenpack in collaboration with Dow Jones, and Bloomberg, these are very expensive, even for a prop trading firm. Now, for a retail trader, obviously it becomes out of their leagues. But then there are some other tools. There is a firm called Hekyle. They were providing quantitative scores to Yahoo News, and then they are actually a firm which is not very far from where we are based. So their office is not very far from here. Then there is a firm in the Netherlands, SimLab. So there are quite a few firms which are providing tools for small investors, while their quantitative engines might not be as comprehensive. They might not be providing you as many quantitative factors as, say, a Reuters or a Ravenpack tool might provide you, but then they would still provide you some of the scores. You might possibly not be able to use it as a retail investor. Obviously, you are not going to use it to be the fastest to respond. So that involves a lot of investment in technology. But these tools will provide you a score at the end of the day. You are with a certain lag, 15 minutes lag, half an hour lag. But then you can still use it for forming broad viewpoints about the market and trading in the market. So as a retail trader also, you could definitely use it.
Well, algorithmic trading requires you to merge two traditionally disjoint set of skills. One is finance, another is technology. So you need to merge skills in finance and technology to be able to do algorithmic trading. So you need to understand the markets, you need to understand big data statistics to be able to design your strategies. But once you have designed the strategies, you need to also understand technology to be able to automate your strategies. So therefore, that is where the Quantity's education programs come into place. So we train people about the entire gamut of operations and skills required to be able to be a successful algorithmic trader.